Hello and welcome. Today, we will discuss Warren Buffett's perspective on investing as a loser's game and how his investment strategy has made him one of the most successful investors in history. Unlike many investors who view the market as a game they can win, Buffett sees investing as a loser's game. This means that he believes the key to successful investing is not about beating the market, but rather about avoiding costly mistakes. So, what does it mean to view investing as a loser's game? In a traditional game, such as tennis or chess, the players are actively trying to beat one another. In contrast, in a loser's game, the goal is not to win, but rather to avoid losing. The players in a loser's game are often amateurs who are not highly skilled, and their mistakes tend to be more costly than in a traditional game. Buffett believes that the same principle applies to investing. He sees the stock market as a loser's game because it is dominated by highly skilled professionals who have access to the same information and tools as everyone else. Therefore, it's very difficult for individual investors to consistently outperform the market. Instead of trying to outsmart the market, Buffett recommends that investors focus on finding solid, well-managed companies with good long-term prospects. By doing so, investors can avoid the costly mistakes that often plague amateur investors who are trying to make quick profits. In the previous section, we talked about why Buffett views investing as a loser's game. Now, let's delve deeper into his investment strategy and see how he has become one of the most successful investors in history. Buffett's investment philosophy is centered around value investing, which involves identifying undervalued companies that have strong fundamentals and holding on to them for the long term. The stock market can be irrational in the short term, but it eventually becomes more rational over time. Therefore, by investing in companies with good long-term prospects, investors can benefit from the market's long-term value and reap the rewards over time. In addition to focusing on strong fundamentals and long-term prospects, Buffett places great emphasis on finding well-managed companies. He believes that a company's management team is crucial to its success, and investors should look for companies with trustworthy and competent leaders. Furthermore, Buffett is known for his aversion to risk. He prefers to invest in companies with a margin of safety, which means that the company is trading at a discount to its intrinsic value. By investing in companies with a margin of safety, investors can minimize their risk and increase their potential for long-term gains. One of the key advantages of his approach is its consistency. While other high-risk strategies may result in occasional big wins, they are also more likely to result in big losses. On the other hand, Buffett's value investing approach has consistently produced steady returns over the long term. Now that we have delved into Warren Buffett's investment style, let us explore some of the benefits that come with adopting this approach. One of the key benefits of Buffett's investment style is its consistency. By targeting reliable, well-run companies with strong long-term growth potential, investors have the potential to earn stable returns over an extended period. This consistency is particularly advantageous for investors who are aiming to achieve long-term financial objectives, such as saving for retirement or their children's education. Another advantage of his investment philosophy is its simplicity. While many investors are drawn to complicated investment strategies and exotic assets, Buffett's approach relies on a few fundamental principles that are easy to understand. This simplicity makes it accessible to investors of all levels of experience. Moreover, by minimizing risk through a margin of safety and avoiding costly mistakes, investors who follow his approach may be better equipped to weather market downturns and volatility. Although the market can be unpredictable in the short run, investing in dependable, well-managed companies with solid long-term prospects can help investors remain steadfast and achieve their financial goals over time. Buffett's investment style is particularly well suited for those who prefer a hands-off approach to investing. By holding on to quality companies for the long term, investors can steer clear of the temptation to frequently buy and sell stocks, which can be time-consuming and expensive. This passive approach can be particularly appealing to investors who have other commitments or who favor a more relaxed approach to investing. One of the primary reasons why Warren Buffett has been so successful over the years is his focus on quality. Buffett only invests in companies that he believes have a sustainable competitive advantage, a strong management team, and the potential for long-term growth. By focusing on these factors, Buffett has been able to avoid investing in companies that are likely to falter in the long run, while also benefiting from the growth potential of his chosen companies. Another important aspect of Warren Buffett's investment style is his long-term mindset. Buffett is not interested in short-term gains, but rather he invests with a view to holding on to his investments for many years. This long-term approach allows him to benefit from the compounding effect over time, while also minimizing the impact of short-term market fluctuations. While Warren Buffett is known for his concentrated portfolio of stocks, he also emphasizes the importance of diversification. He believes that investors should only invest in companies that they truly understand, but that they should also spread their investments across different industries and sectors. This helps to reduce risk and provides a buffer against any unexpected events that may affect a particular industry or sector. While Warren Buffett's investment philosophy has proven successful over the years, it's not without its challenges. One of the biggest challenges of adopting Buffett's approach is the patience required. Buffett's strategy involves holding on to stocks for the long term, often decades, which can be difficult for investors who are used to seeing quick returns on their investment. It can also be difficult to resist the temptation to sell stocks during market downturns, which can be a costly mistake in the long run. Another challenge is the level of discipline required to stick to the fundamentals of value investing. It's easy to get caught up in the hype surrounding a hot new stock or investment trend, but Buffett's approach emphasizes the importance of staying focused on the fundamentals of a company's business model, management team, and long-term prospect. This requires discipline and a willingness to tune out the noise of the market. Additionally, finding companies with a sustainable competitive advantage, strong management team, and long-term growth potential can be difficult. It requires a significant amount of research and analysis, and there is always a risk that the company's prospects may not play out as expected. While adopting his approach is not without its challenges, its simplicity and accessibility make it a popular choice for investors of all levels of experience. By remaining focused on the fundamentals of a company's business and avoiding the temptation to chase quick profits, investors can improve their chances of success in the stock market. Thank you for watching our video on Warren Buffett's approach to investing. We hope you found it informative and useful. Don't forget to like and subscribe to our channel for more informative video on investing and finance.